they're marketable securities that have both middlemen, and your returns are just going to be way less because the institutions and the middlemen are taking all the returns away. And this is why we do what we do, because there's a lot of hardworking people out there who blindly put their money into the 401ks and REITs and stuff like that. And the institutions are just taking your money.
This is a story about a dude named Lane. Then one day he went to try to rent them out, and then he became one of the domain.
Question: why invest in syndications instead of REITs? Many reasons. Because, well, REITs are like retail products. And what are retail products? Are all the stuff that you're finding in your 401k, all these garbage investments, in my opinion. And I call it that because it's like going to shop at Nordstrom or Neiman Marcus for the same t-shirt or collared shirt, and you're paying this higher price for all like the marketing and overhead of the larger institution, where you could just buy it on Amazon or go to China and buy it for $2. REITs are probably the same thing that syndications are, in minus a few ways. But the main thing is, like I said, they're marketable securities. They have both middlemen, and your returns are just going to be way less because the institutions and the middlemen are taking all the returns away. And this is why we do what we do, because there's a lot of hardworking people out there who blindly put their money into the 401ks and REITs and stuff like that. And the institutions are just taking your money. The analogy I use a lot of times is it's not like your high school. It's my high school cafeteria. You're stuck there. You're stuck with all these crappy offers. Marriott did our food service at my school and just stuck there, and this food sucked and it was really expensive. I went to private school where it wasn't subsidized. And what do you do when you get your off-campus pass? You get the heck out of there and you go and eat, maybe not the best analogy, but you go and eat Taco Bell, McDonald's, Burger King, all the good tasty stuff that's really cheap on the outside. And that's synonymous with you guys, alternative investors, busting out of the cafeteria and getting to the good stuff where you don't have all these markups. One interesting thing about REITs, now REITs are supposed to pay out 90% of their earnings to investors, which sounds really good. It's probably put in by some consumer advocacy group, but that may not be best for the asset. So I know a lot of times we won't pay out 90% of the profits. We won't keep it for ourselves. We'll keep it in the bank account for cash reserves. And why do we do that? It's not like we don't like you guys, but our number one priority is the asset, right? Holding onto the asset. We know there might be bumpy roads ahead, so we want to keep a certain amount of healthy cash reserves in there at all times. We may want to put more and more rehab into there. A lot of times, like the bank account being built up to $80,000, $100,000 plus, we could certainly pay out $60,000 of that to investors on that quarter, but we may elect to, let's go and do that. We didn't plan to do the playground for some reason, right? Let's go ahead and do it and expand. Just using that as an example. Why? Well, because we're probably going to be able to yield another $20 of rents in every single unit because of that. And that is a reason. And at the end of the day, this is why you're in a syndication where the GPLP is aligned. At the end of the day, we only make money, or you guys only make money when we make money, or maybe we make money when you guys make money. So we're aligned in that fashion. And it's not like we don't want to pay you guys. What we want to do is we want to sell that asset for more at the end of the day. And that is going to be the better business decision than paying 90% of the profits back to investors. But big thing, number one, REITs are retail products. And this is, we mentioned before how we stay above mom and pop investors, getting better deals than they do, better economies, but we're also staying below the large institutional investors. These guys are buying dozens of properties at a time in the thousands. Sometimes they come down and they'll compete with us on like a 500, 600, 400 unit property. Not often. They're more looking for clumps because the buyer for that is some big faceless institution investing dumb retirement money, long-term dumb retirement money where they have a very low threshold for returns because they're investors. They're used to the 7, 8, 9% on this type of stuff, especially in like the REITs. REITs returns aren't that high. So that's who we're competing with. So they could be a lot more aggressive on their pricing. They can offer, say, 35 million, where only we could go up to 31, 32, for example. That's how the environment and why we stay in this middle sweet spot in terms of syndication. So we can get above the mom and pop investors, but stay below the big guys. And what we're doing is when we're buying these properties, we're fixing it up, taking it the rest of the way. We typically start off with stabilized assets already, but we want to go through and just bump those rents up even more. And really, that's what the lazy, large institutions want to buy to put into the REITs, to put into their big portfolios for retirement, retail buyers. So the idea is a lot of times our exit strategy, which we don't plan for in the numbers. We plan to sell to just another investor like ourselves. But what we don't account for is possibly selling to a large stupid REIT that will pay a much lower cap rate because they're not that picky in terms of returns, like I said. So if we can package, and this is why we strive to get a certain amount of economies of scale so we can sell back to one of these REITs a nice little package of a couple 6+ properties or get above 1,000 units. We like to do that in addition so that we can build up economies of scale with property management, and then we can share resources amongst different properties too as a second reason.
This website offers very general information concerning real estate for investment purposes. Every investor's situation is unique. Always seek the services of licensed third-party appraisers and inspectors to verify the value and condition of any property you intend to purchase. Use the services of professional title and escrow companies and licensed tax, investment, and or legal advisor before relying on any information contained herein. Information is not guaranteed, as in every investment there is risk. The content found here is just my opinion, and things change, and I reserve the right to change my mind. Above all else, do your own analysis and think for yourself, because in the end, you are the only person who is going to look out for your best interests.